So welcome to financial accounting. Today we want to look at something that I'm going to be able to share even as we proceed. But before I share anything, I know that we are now set for the exam. And set for the exam, I do believe that right now we have registered for the exam and we are now set for the exam that is ahead. What does that mean? It means that we have to do something within the next 1 month to get ourselves ready for the exam. That's basically we need to do something that gets us ready for the exam. Why I'm starting from here, from this page, somebody's we need to mute. Oh, okay. So from the last time we interacted, I remember that something that I did share. I think I shared with you something on WhatsApp. That's a topic on end of year adjustments, but also something to do with bad debts and then depreciation. From what we have gone through so far, do we have any questions? Do we have areas of challenge from what we have gone so far? Do we have like questions that you'd want to ask, especially on the materials that I did share? Now, I should not be asking the questions because I understand that we have the WhatsApp group as an opportunity, but I'll first use this chance to just ask if there are any questions, and then I can handle those before I can take you through what I have prepared for today. So somebody says, Jacqueline says yes. Jacqueline, do you want to unmute and ask?
Yes, sir.
Please go on.
I was asking on this part for depreciation. When they give you, like when they tell you to what? To do that thing for motor vehicle account, and you have something like they paid for license registration, is it also included in the amount for the vehicle when you're purchasing it?
Okay. That is your question.
Yes, and also insurance and non-refundable taxes, are they added?
Okay. Thanks so much for the question.
You're welcome.
With that question, I just want to say that we have what we call revenue expenditures. We have what we call revenue expenditures, and then we have what we call capital expenditures. Now, you need to understand how these two come into play. Now, what we're talking about here are the non-current assets. And one of the examples that you have brought is a motor vehicle as one of the non-current assets. Now, there are expenses, or let's just use the word expenditure. There is expenditure that we incur on motor vehicle that could be classified as revenue expenditure or could actually be classified as capital expenditure. Now, what we classify as capital expenditure are those expenses that bring into operation an asset. And these capital expenditures, if you to look at them specifically, we're trying to look at, let's say, the cost of the asset. The cost of the assets. We are trying to look at any other cost that brings that asset into operation. And you brought in the aspect of insurance. So insurance, we call it CIF. Every time you bring into a vehicle or something, we have what we call the CIF cost, which includes the cost, insurance, and freight. Now, this so-called cost is actually capitalized, because if you're buying a vehicle from, let's say, from Japan, that vehicle will not just be the value of how much you've paid the Japanese, but all that is incurred in bringing that vehicle to its station, let's say Kampala, those are costs that we need to capitalize. So the CIF cost, the non-refundable taxes, as you have brought it. Now, reason why we say non-refundable taxes is because when we are bringing in, let's say, a vehicle or any other asset, we incur costs like, we incur taxes like VAT and import duty. Now, VAT for a company that is registered for VAT is claimable, because this VAT that we incur at this level is actually input VAT. And if you you have acquainted yourself with how taxes work, when you're filing your VAT returns, this so-called input VAT is actually netted off your VAT from your sales, okay? Because we have output VAT for sales, and then we have input VAT, which relates to purchases, basically inputs, raw materials, and so on. And any VAT that you have paid to your suppliers is called input VAT. Well, VAT that you've received from your customers is actually called output VAT. So when we're bringing an asset, we will incur non-refundable taxes, and one of it may be VAT. If at all we are not registered for VAT, then that VAT will be non-refundable. If we are registered for VAT, then we can claim that VAT while we are preparing our VAT returns. And then we have the import duty. Import duty, this is actually not refundable. For vehicles, especially those that have a bit older, there's also an environment levy, I think even for new vehicles as well. The environment levy is also is actually also non-refundable. So all the taxes that are non-refundable need to be added to the cost of the asset as it is being brought into operations. Now, all those are, we call them, now, even if it was a machine, let's say it was, let's say that needs to be installed, installation costs would also need to be included in the costs of the asset that is going to be depreciated. Okay, basically you're saying that the cost of the asset that you're going to depreciate has to include all these. Basically, your cost of your asset has not only just be the price that you paid, but should also include other costs that brought this asset into operation. Okay, so that is very important when it comes to this, and thanks so much for bringing up this. Now, we have what we call the revenue expenditures. Now, these revenue expenditures, the examiner usually has sometimes wants to bring these two things and mix them up. Now, in case you had, let's say, some fines while you're bringing in these assets, fines are not supposed to be capitalized. Maybe at the border, you either you did the wrong, declared wrongly the value of your asset and you got a fine. That cost is not revenue, is not capitalized, so you don't add it to the value of your asset. Maybe fuel cost from from your business to the field. Now, why I want to bring in this is that, let's say you have bought a vehicle. Maybe you deal, let's say you're an NGO. So you bought a vehicle, it gets to Kampala. Maybe your office is in Kampala. So the vehicle gets to the Kampala office, and then you've costed all those costs. And then this vehicle has to move now to go maybe to Arua, where you have some business. Now, the costs for that are supposed to be capitalized only end when the vehicle gets to its your business premises. Anything beyond that would now start to be revenue expenditures. Anything to do with maintenance of the assets. This one will also be kind of the maintenance expense will also be a revenue expenditure, or sometimes they can call them repairs. If they are repair costs, these are all revenue expenditures. Okay, so this is very important to know that some costs actually need to be capitalized. And this is according to, of course, the standard that is in relation to plant, property, and equipment.
A question, please, before you go further on that. Those revenue expenditures expensed off in the P&L? Oh.
Yes, these revenue expenditures are expensed off in the P&L. Well, these other expenditures, these ones, since they are added to the cost of the asset, these we represent them within our statement of financial position. And remember, we also have to depreciate them. Is that okay? So that is what we usually do. So the examiner expects you to understand the differences between revenue expenditures and capital expenditures. If it was a building, okay? If it's a building, construction materials and so on, all that are being capitalized. But a case in point, maybe you have a building which is already in existence, already operating, and then you go on to paint the building. Painting costs are revenue expenditure costs. Why? Because they don't add on any capacity for the building. It's just for beautifying and all the other. So they are just revenue expenditures, okay? But anything to do with construction, maybe you're breaking a wall, you're extending and so on, you're going to capitalize those costs. So it's very important that you distinguish this. You'll be able to interface with this so much, especially when you're looking at questions to do with depreciation. Okay. Yeah, so that is quite very, very important. So ideally, we should add and depreciate the assets accordingly. I don't know if that was your question, Jacqueline. Have I answered your question?
Yes.
Okay, thank you. Yeah.
You're welcome.
Other than Jacqueline, do we have any other question? From what you've gone through, I want to just utilize this time to ensure that we are on the right path, that in case there's anything that confused you, it's something that I'm able to provide clarity accordingly before we can proceed. And I'm very assuming at this point in time that all of us were able to go through all the materials that I've shared with you, because it's very important that we're moving at the same pace. We have a very limited time to the exam, so we don't want to take any chances, okay? We want to ensure that we are giving best to our study and we're getting there. For the last couple of classes, we have been so much focused on building our capacity in terms of understanding the concepts and so on. So whatever we are going to do following this level is to now dig into to understand the application of, let's say, the end of year adjustments. How can they be used or how can the examiner examine them? So that is very important. And that's why I started with this side, because I know that all of us have right now we have access to this site, which is the ICPAU website. Okay, now even getting your permits and other details, results, and so on will all be gotten from here. But one of the important things here that you're going to leverage on are some of the resources that are on this website. And these resources are the past paper questions. Now, right now, you should be able to start looking at the past paper questions to see, can I be able to attempt some of these questions? For example, we're seeing one of the papers here, December 2022. Just trying to download this paper to see what exactly was examined. This is the last paper. So for us to know that this paper continues to be with 3 hours and 15 minutes, and in this first 15 minutes, you expected to take time to read and select respective questions that you're going to attempt. Section A usually contains multiple choice questions, objectives, while section B contains 5 questions, of which you're supposed to choose 4 questions. And definitely, of course, they're telling you to write your answers to each question on a fresh page in your answer booklet. So the examiner here came and said for us question 2. Now, they usually don't find question 1 on the website, but these are resources that you can be able to find. I'll be able to share with you some objectives that can help you understand how section A can be examined. So this is question 2. And for question 2, the examiner gave us information relating to Mutaki Limited manufacturers for their end date. As you can see how this information is laid out, this information is actually laid out in form of a trial balance, because they have given us, they're giving us details, they're giving us the debit, then they're giving us the credit. Now, right now, you should be able to understand what a trial balance is. You should be able to understand why for share premium, it is on the credit side, and why you have something like land and building to be on the debit side. Why? Because these are the balances of these items. Land has a normal debit balance. Buildings have a normal debit balance. Plant and machinery have a normal debit balance. Inventory is a current asset, which also has a normal debit balance. Right here, you're seeing these broken down: raw material, work in progress, finished goods. Now, as we proceed, you get to realize that for manufacturing companies, they usually have inventory in 3 categories. They usually have inventory that is in raw material form. They usually have work in progress. They have finished goods. A case in example, if you're looking at a company, let's say, let me use a company like, let's say Coca-Cola. When 31st December ends, if that is their year end, they'll definitely have products they have finished producing. They'll have some products that are just in the process. Maybe they have not yet put maybe covers on them. Maybe it's still in liquid and so on. But then they also have goods that are already, let's say, in the crates, already packed and so on. So all those have to be valued, and you have to present them within your, you balance off the ledgers and you present them within your trial balance. So that is how you're able to see all this information. So they have given us a lot of information here, but each of them, you should just know that if I'm seeing salaries and wages and they're on the debit side, then that means that these are expenses. So all this information you can now interpret. You should be able to know why, if we have, let's say, depreciation, because they're saying depreciation on, yes, just a moment. So I was just saying that right now you should be able to know why we have these costs the way we have them there, why they're on the debit side, why on the credit side. So I was saying that for such a question, as you can see, they give us depreciation, and they said depreciation on building, plant and machinery, furniture and fittings, motor vehicle. Right now, you should be able to tell why this 33,000, these balances, and this is actually accumulated depreciation. As the examiner called it depreciation here, you know very well that whatever is on the credit side, because depreciation is an expense, okay? Depreciation is an expense, and we usually calculate depreciation every year. And depreciation is an end of year adjustment. So you usually have your first draft of the trial balance before you actually do depreciation. So this depreciation they have given us is accumulated depreciation as per se. So it's very important that you know what you're reading. You can see we have provision for doubtful debts. Why? Because these also have a normal credit balance. We have repairs and maintenance. This is an expense. We have many things here. We have discounts received and so on. So here the examiner again gives us more information. Okay, they are giving us inventory, closing inventory. Why they're giving us closing inventory here is because while we are preparing our financial statements, especially the statement of financial position, our focus is on closing inventory. Because remember, our statement of financial position is as at the end of that period. So we do record closing inventory within the statement of financial position. So we need closing inventory just as we need opening inventory. When we are doing the profit and loss, we know very well that for the profit and loss, we'll have opening inventory, add purchases, and then less closing stock, like that. So it's important that we know how all these come into play. As you can see here, the examiner goes on to give us the depreciation. It's okay. You're welcome. Right here, you understand why the examiner is giving you this information. Why? Because when you come here, they say depreciation on plant building is this. And I've told you that this information is actually what? This information is accumulated depreciation because it's on the credit side. And that's why the examiner is giving you how to calculate depreciation. Okay. And then also, one thing you also need to note is that as we have depreciation for these different items, we also have the value of each of these items. Right now, you know very well that land does not depreciate, but building does. And that's why even you see 2 here, this is a note. When you come to here, this is the note that is 2. So right now you should be able to know how to calculate depreciation for these assets. A case in example, they are telling us that for building, it is 15% straight line. So what that means is building 15% straight line. Whenever they say straight line, we subject 15% on the cost. We subject 15% on the cost. Straight line is on the cost. So I'll just get 15% of how much? Of the building cost. When you look at this building cost, the building cost is 220,000. So I'll just get my 15% and subject that on the building cost. So if I have 15% of how much? Of 220. So my depreciation for building is actually that, okay? I just bring this here. This is building cost. This is building. Let me just call it building. And here, I'm trying to do my working for depreciation. So let me just try to confirm what I have within my paper. So I have, this is 220. Since it has 3 zeros, I'll just try to include the 3 zeros there so that I'm able to 1, 2, 3. I'm able to have a much better figure. So actually my depreciation is 33 million, okay? It's 33 million. So let me first calculate for another one and then I'll tell you what I want to do exactly. So if I have now plant property and plant machinery as the second item. I want to ask myself, what is the depreciation for plant and machinery? So plant and machinery, they are telling me it's 20% reducing balance. So what that means is, now we say that for depreciation using reducing balance is usually on the net book value, okay? Is usually on the net book value. So you would want even to show the examiner that depreciation here will be, let's say, the percentage of depreciation multiplied by the net book value. So the percentage we have is 20%. And this 20% has to be multiplied by our value for the plant and machinery, which we have as 350. Now here I'm assuming that this is the information, all the information we have, and we've not done any sell-off of these assets, because when you're trying to depreciate at the end of the year, you should ask yourself if there were any disposals, okay? Because those would definitely affect your depreciation amount. So as we can see, our depreciation value is at how much? Is at 70 million. And then we do have, now before I do proceed, why am I doing all this? Is because the questions that are being required here. Now, this is the question on manufacturing accounts, and I'll be able to comment on it. But I just want us to get to understand that whenever we are given a trial balance and we're given some additional information, we use the additional information to work around the question that we have at hand. So you'll do the same thing for furniture and fittings. You do the 12%. Now, furniture and fittings is on cost. Since it's straight line, so it will be 12% times furniture and fitting cost is actually 24 million. So that is very clear. And then motor vehicle is 25% times this is reducing balance. So this will be 25% in the net book value. The net book value of these assets, sorry, I was supposed to do the same thing here. Sorry, here this is not supposed to be 350. It's supposed to be the net book value, which is supposed to be the 350,000, which is the cost. Okay, this is the 350,000, which is the cost, less the net book value for plant and machinery. I'd forgotten to apply that. So 70,000, this is 70 million. So that is what is supposed to basically be, okay? You can catch this on your what? On your PC or something. Should be able to give you 56 this. This is reducing balance because it's a net book value. Net book value is just given by cost less accumulated depreciation. And that's why I picked the cost, which was 350 and less 70 to come to 56. This was for plant and machinery. And I have said that if it comes to our so-called furniture and fittings, you just do the 12% directly onto this value, 24,000. And for motor vehicle, which is now again on reducing balance, we shall do 25% of the 200,000 minus, okay, basically get the 200,000 less 50,000, which gives us 150,000. And that value is what you multiply by the 25%, because that is reducing balance method. Okay, that is reducing balance method. So that is what usually for the depreciation for CPA, you just need to understand these two methods. Depreciation has several other methods, but for this paper financial accounting, you only need these two methods. The so-called method on straight line and reducing balance. That's all you need. Okay, that is all you need. So that is with depreciation. I'm just trying to go through some of the end of year adjustments that you might have gone through the video that I shared with you, just to understand how to look at some of these expenses at the end of the year. Okay, so let's see here. Let's just look at this. So they're telling us that the loan was obtained on 1st December 2021. The loan. So when you go to the trial balance, you'll actually realize they have a loan. They have this loan, which is 200 million. So remember, we are looking at books of accounts for 31st December 2021. So they are telling us that the loan above was obtained on 1st December 2021. The monthly installment is 5523783, of which the principal component for December 2021 was this. Remember, they got it on 1st December 2021, so they have only paid for 1 month to the year end. They got in December, the year ended in December. So what they have paid in December, the monthly installment is this. And they're telling you that the component for the principal is this. Now, why this is important for us, especially for loans, is that we recognize interest differently. The interest on the loan, which is a finance cost, is expensed, is part of our operating expenses, okay? So we need, whenever we are paying back any loan, we should understand what is the composition, what is interest, what is the principal. So they are telling us something here. However, ML reached an agreement with the bank to only pay the interest for the month of December, excluding the principal. So although this is the monthly installment, ML negotiated and they say that they should only pay the interest, which interest would be this monthly installment minus what should be our principal. They are telling us that the interest remained accrued at the year end. So despite us reaching an agreement with the bank to only pay interest for the month of December, of course, they are saying, I think they should not pay the principal in December. They are telling you that although the interest, they negotiated, the interest remained accrued at the year end, which means that the interest for December was not paid. So it will be part of your accruals. And we say that accruals are recorded under our liabilities. So you have a liability as part of your liabilities. If you're doing your statement of financial position, as part of your liabilities, you have what we call accrued interest of that much. So they're telling us that it's a company's policy to account for interest as part of office and industrial administrative expenses. So we know very well that if it's an accrual, it is going to the balance sheet, which is statement of financial position, but it will also go to our profit and loss and our expenses. So here they're trying to just tell you that you should classify this interest under your office and administrative expenses. Now, this is very common with manufacturing organizations. They usually classify their expenses in the category of factory, costs, administrative, office and administration, selling and distribution. And we shall learn why that is the case as we proceed. So just want us to look at these items, those 3 items right there. So one of the items they're telling us is that shillings 450,000 of the total utilities paid related to the period that commenced 1st January 2022. Shillings 450,000 of total utilities paid to the period related to the period that commenced 1st January 2022. Now yours is to go back to the trial balance to see what utilities do we have. So when you come here, you have utilities of 8,450,000. Utilities of 8,450,000. So they are telling you that of this money, 450,000 relates to utilities that are for the period that commenced 1st January 2022. Remember, your financial year is ending 31st December 2021. So any expense that relates to the next financial year is a prepayment. So they are basically telling you that this so-called 450 is a prepaid utilities. And we know what happens with prepaid utilities. We recognize these prepaid utilities as current assets. We recognize them as current assets. So as part of your current assets, if you're doing your statement of financial position, I would expect you to include prepaid utilities for 450,000. But also, when you're going to record your so-called utilities expense, you need to remove the 450, because as it is 8,450,000 here in the trial balance, your expense for this period should only be 8 million, because the 450 they have told us relates to the next financial year. So in case you're recording within your profit and loss, you should record only 8 million, because that is what is relating to this financial year. So that is important. Now, I also want to highlight something here. This is for utilities, okay? And these are prepayments. So this is okay. Let's just look at this part 5. They're saying as the following expenses remained outstanding by the year end: repairs and maintenance shillings 8,050,000, and salaries and wages to 250,000. So these expenses remained outstanding. Now, these expenses that remained outstanding have to be accrued. Okay, and this is where the accruals come in. Now, because they have given you this information in the additional information, because even they are telling you here, do you have additional information? So it means that if you have, let's say, repairs and maintenance, when you see repairs and maintenance here, and they have put a comment of 5, means that this 21,950 is exclusive of these costs down here, 8,050. So you should go on to recognize the accrual. Okay, and we say that for accruals, what do? We debit the expense and we credit the respective accrued expense. So let's say in case these are repairs and maintenance, we shall do that as we are crediting our accrued repairs and maintenance here, means that we should debit repairs and maintenance there. That is how we are going to handle it. Now, what that will mean is that when you're preparing your profit and loss, you need to add this 8,050 onto what is already existing, the 21 million that is existing, so that you get a figure that best represents your repairs and maintenance for the year. The same thing is also going to happen for your so-called salaries and wages. As you have 250,000 here that they're saying remained outstanding, means that your salaries and wages that you have here exclude that 250,000. So you should add this 250,000 onto what you have as the 24 million, so that you get a value of how much are your salaries and wages for the year. Now, when you go to your statement of financial position, which is your balance sheet, you have your accruals. You have accrued repairs and maintenance of 8,050, and you have salaries and wages of 250,000 as well. So it's very important that you know how to record these. Now, I just want to look at something here, so-called bad debts. Okay, I hope that for these others, we are comfortable. Okay. Can somebody confirm that everything is okay? Have we understood for these others?
Yes.
Okay. Okay, fine. In case you have any challenge, please feel free to
please pardon on that 5 expenses, that one.
Okay, fine. Thanks. So this I say that when you look at your trial balance here for salaries and wages, they have a note of 5. And I said these are salaries which have a normal debit balance. And that's why you're seeing them having a value on the debit side of the trial balance. The same thing with repairs and maintenance. They also have a value on the debit side of 21,950. So they're telling you that they have a note 5. So when you go to note 5, they're telling you that the following expenses remained outstanding by their end: repairs and maintenance, shillings 8,050,000, and salaries and wages of 250. This means that although we have the other figures up in the trial balance, these figures here need to be updated with their respective figures there. And I say that if they're outstanding, then we have to accrue them because they are expenses that relate to this period. Remember the accrual concept, which says that we recognize expenses as and when they are incurred and revenue as and when it is earned, and not necessarily when cash transfers hands or exchanges hands. So these expenses, although they're outstanding, we should recognize them for this period. So that is why we debit our, I say that when we are recognizing these expenses, we do this double entry. If it's repairs and maintenance, we shall debit our repairs and maintenance with this much, the 8,050,000. Okay, so that is what I'll come and do. I'll come and put the respective amount there as I've been given the amount. So this is my double entry, but also if I am doing a profit and loss, I know that if I'm debiting my repairs and maintenance, it means that they are increasing. So it means that when I'm doing my so-called profit and loss, I'll get the 8,050,000 and add it onto the 21,950. Okay. Yeah. So Hajra, I hope that is okay.
Thank you so much.
Okay, you're welcome. So I just want us to look at this one and be very attentive here. So they're telling us that during the year, management reached a decision to increase provisions for doubtful debts to 10% of the total amount of the accounts receivables. No entries have been passed by the year end. Now, right now, you should be able to know what provision for doubtful debts is, or provision for bad debts. When you go to your trial balance, you realize that we have some provisions for bad debts. We have 1840 as provision for doubtful debts. So they are telling us that management reached a decision to increase these provisions to 10% of the accounts receivables. The entries had not been passed at the end of the year. What do you exactly do? So what I usually do for provisions, I'll say my provisions. Okay, before I proceed provisions, somebody just asked a question here. So if I get you well, on number 5, we will add the amount, the value in the balance sheet. I just need to restate this again, that for item 5, remember, repairs and maintenance is an expense. Repairs and maintenance is an expense. In the profit and loss is where expenses go. So it is in the profit and loss or statement of comprehensive income where we add the 8,050,000 onto what we already have as repairs and maintenance. Repairs and maintenance don't go to the balance sheet or the statement of financial position. Now, in this case, the only cost that will go to, the only value that will go to the statement of financial position or balance sheet will be the outstanding repairs and maintenance because it's an obligation. Now, this one, we shall not add it to any value because we don't have outstanding. We don't, in our information here, we don't have any outstanding repairs and maintenance from the previous period. So what that means is that we will just have a single line under our liabilities, as we've listed accounts payables and so on. We will have outstanding repairs and maintenance, or you can call them accrued repairs and maintenance, and put 8,050,000. And for salaries and wages, we shall also say outstanding salaries and wages, 250,000, and put the amount. Dorothy, is that clear?
Yes.
Okay, fine. Thanks. So Dorothy had taken us back there, but it's okay. It's okay to ask because we want to ensure that we are learning together. So provisions. So when I'm trying to calculate my provisions, this is what I do. I look at my old provisions, okay? I look at my old provisions, and then we look at the new provisions. And then compare which one is higher than the other. So as we can see, our old provision as per what we have in the trial balance is 1,840,000. $1,840,000. That is what we do have. For this financial year, for the new financial year, they are telling us management agreed to increase 10% of the total number of accounts receivable. So we have 10% of accounts receivable. So accounts receivable are here within our trial balance. Now you see what the examiner has done here. And the examiner usually does it, usually combines things in the same line. So you have accounts receivables and payables. So yours is to understand that accounts receivables have a normal debit balance, so they will be on the debit side. Well, accounts payables have a normal credit balance, so they will be on the credit side. So if I want the value for accounts payables, I'll pick the 36,800. That is what I'll take to as my accounts receivable. So the new provision, they are telling us that this is 10%. This is 10% of how much? Of that value. Okay? And if you try to calculate this, %. Remember, this one has the 3 zeros. So you have 3,600,000 3,680,000 right there. Now, remember our previous what we had? We had 1,840,000. When you get 10% of accounts receivable, we are using what we have. We have this value. So you now compare this value and this value and see, do you have an increment or a decrease or an increase? Increase or decrease. Now, if it is an increase, like in this case, we say the double entry for the increase will be debit, bad debts, and credit, provision for bad debts. With the increment. With the increment. So the increment is basically, in this case, the difference between this value and that value, okay? So you should be able to get the difference, which is actually the same value. The difference between this and this is actually the same value. So that is the same amount that we also, we do have here. So this is just coincidence that they're the same. So this is what we do. So when you sometimes you have a value of bad debts within your trial balance, but in this case I don't see any bad debts anywhere. So it means that if we don't have any, then we shall take this value as it is, this value of bad debts as it is within our profit and loss or statement of comprehensive income. And then for provision of bad debts, since we are creating provision for bad debts, it will actually add to.
What if we had bad debts? Would we add on the figure to the old one, the one that is in the trial balance?
Yes, we shall add that value onto that figure, because ideally, if you're doing this, let's say if these were actually ledgers, you need to understand that every time you have a change in, let's say, bad debts, in your bad debts account, you have your balance brought down, which in this case is 0. And then any increase is recorded here to add on to what is existing. For example, the increase here is 40,000, 40 million, 1840, just to try to, I think I put more figures. Okay. 1.8 that. So when you balance off your new account, it will be the total of these two, okay? The same thing with provisions. You realize that if this was, let's say, if I was looking at it from the provision account, if I'm doing a ledger for the provision account, provisions have a normal credit balance. So just know that I'll have my balance brought down of how much. This is my old provision, will be my balance. And then I'll add an increment Remember, as I'm debiting it here, I'm crediting it in the provisions account. So our increase here was of the same magnitude, which is that. So at the end of the day, when you balance off this account, your balance brought down will be 3,680. Well, when you balance off this account, it will be 1,840. So that is what we exactly do. Now, in case it was a decrease in provisions, we usually do this. We will debit provisions for bad debts. We will debit provision for bad debts, and we are going to credit the profits or loss account. That is what we do. Debit provision for bad debts, credit profit or loss account with the decrease. So in case you had your bad debts in the trial balance, this time you don't reduce them, you put them the way they are. But when you come to your other incomes in the profit and loss, you have a decrease in provisions under your other incomes. Just after gross profit, you have other incomes of that value. Well, for provisions, you go and reduce it. For example, in this case, if, for example, you had 1,840, but again, in that period, you had a decrease of, let's say, 1 million. You record the 1 million this side, which means that is going to reduce your account, but to remain to 840. So that 840 is what you deduct from your accounts receivable in the balance sheet. Remember when we are presenting provisions in the balance sheet, we write accounts receivable and then deduct the provisions. I know for some people who have not gone through the videos that I've shared with you for end of year adjustments, these things are totally new to you, which is very unfortunate. So I encourage you to go through those class sessions to ensure that you are acquainted with how bad debts operate. Okay? Yeah, so this is what you're supposed to do. Now, I just want to share as well here that there are some times when the examiner will, especially for provisions, where they will tell you that management also wrote off some bad debts. Okay? In case you have some bad debts written off in the period, you will have to first remove them from your accounts receivables. Now, bad debts are those people that are not going to pay you. And why we write off some of them is because we have confirmed they're not going to pay us. Either the company has gone bankrupt, either they are dead, or either they have moved permanently to a new country. There could be reasons that make us write off these bad debts. Maybe we have chased them over and over, and we can no longer get the money. There is no hope that we can get the money. In that case, before even you subject the 10% that we have subjected here, this 10%, you have to first go and first remove the so-called what? You have to first remove those bad debts that have been written off from your receivables, because you can't make a provision for bad debts that are no longer existing, like for debtors whom you've already written off. So that is very important, and hopefully we shall be able to see how a number can be. Now, one of the things that you need to understand is whatever we have learned, it cuts across to all the types of businesses, because we want to look at how to prepare financial statements for different entities. And this is a manufacturing entity. And you have seen that the examiner for all these items, they have brought in the end of year adjustments. And this question is on manufacturing accounts. So for you to pass a question on manufacturing accounts, you do not only need the information, knowledge on how manufacturing companies work, on how they account for inventory, how do you calculate prime cost, factory costs. you also need to understand these things. They cut across. And that's why you see this is a manufacturing accounts number. When you come to, let's say, next question here. This is a question on depreciation. Okay. Hopefully this is a question on depreciation. Yes, this is a question on depreciation. And they're asking you to draw up a combined non-current asset account, a combined accumulated depreciation account, and they also want you to draw up a combined disposal account. Now, this is a typical question on depreciation. Now, here they have brought depreciation as an independent question. Very similar things that we have been talking about, because even when you come here, I'm going to just show you something small. Okay, right here, that the examiners made it very simple, because even in the cost, they have given us the total cost. They have not gone on to break down. Sometimes they even go ahead to break down this cost in terms of what is the cost, how much they in kind bring the asset, what is the insurance, and so on, so that they are trying to test your understanding of revenue expenditures and capital expenditures. So this is a question that you should be able to do right now after going through depreciation. Okay, after going through depreciation as a topic, because here the examiner, when they say combined non-current asset, they expect you to not break down, because as you can see, this question has compactor machines, has a grader in it, has what else is in here? Yeah, only those. So they just want a single account for assets. You don't have to do a grade account and so on. Do accumulated depreciation. They have given you PCL's policy to depreciate assets is what? PCL depreciates all its non-current assets at a rate of 25% per annum. Using what? Using reducing balance method. And they're telling you that depreciation is time apportioned. Now, reducing balance, we know that we are going to subject 25% on the net book value of our assets, not the cost. But when they say that depreciation is time apportioned, what the examiner here is trying to mean is that if you bought an asset if your financial year is ending 31st December 2019, if you bought an asset in 1st December 2019, that asset will only be depreciated for 1 month. And what we shall do is we shall get the depreciation for the year and divide it by 12 to get the depreciation for just 1 month. If the asset is bought in June, which is 6 months to, maybe end of June or beginning of July, which is 6 months to the end of the year, we should only consider depreciation for 6 months. That is what you should do. So that is what the examiner is basically saying in that case, when they are telling you about the policy here. So yours is to draw up these accounts and depreciate them. For example, if you have, they're telling that PCL acquired 3 excavators for a total cost of 1,400 million, which is 1 billion, 1.4 billion, on 1st April 2019. 2 compactor machines for a total of 1,450 on 30th June, and a wheel loader for shillings 800 million on 1st October 2019. If you have this, remember the next transaction speaks of 2020 and so on. Remember they're asking you to prepare PCLs for their ended 31st December 2019, a non-current account, non-current asset account, accumulated depreciation, and a disposal account. Now, in this case, the examiner has not they have not asked you to do the depreciation account, but in one or the other, you will need it, because when you accounting for depreciation, the accounting entries is you debit depreciation and credit accumulated depreciation. So you need depreciation account, which you don't have to draw up here in this case for this question. So it means that you have to depreciate these assets. If I'm just depreciating the excavator, because they are saying the excavators were bought at a total cost of 1.4 billion or 1,400 million, I would get my 25%. Remember, in the year of purchase, if it's 2019, these excavators, their net book value is more of like their cost, because they have not depreciated at all. So for reducing, if I do 25% times net book value, which net book value will actually be the respective cost. Since they don't have accumulated depreciation, they have not been around for the previous period. So if I have 25% times the 1,400, I'm able to get the depreciation for the year for the 3 excavators. But remember, if I'm looking at books of accounts for period ending 31st December 2019, I bought these excavators on 1st April 2019. Now, I have to ask myself, how long have these excavators been in the organization towards the end of the year, which is 31st December 2019? If I bought these excavators 1st April 2019, so I have April, May, June, July, August, September, October, November, December. 9 months, okay? 9 months. So it means that if I'm trying to look at my depreciation, for these 3 excavators, we've said they are 1,400 million, okay? And when they're telling us that 25% is the depreciation. So what I'm saying is, if I'm to get my annual depreciation for these excavators in 2019, what I'm going to basically do, I'll get my 25% times 1,400 million. So it means that I'm going to get actually 350 million as my annual depreciation. But the depreciation for this asset, because it came in 1st April 2019 to the end of the year, which is 31st December 2019, means that it's going to be what? I'm going to get 9 out of 12. 9 out of 12 times the 350 million. If I want to determine, okay, I get 350 million, yes. So the 9 out of 12, because this asset has been in existence for 9 months towards the end of the year, this should be able to give me my depreciation for the period, okay? This should be able to give me my depreciation and just the 350. So this is what I'm able to get. Can add the million zeros so that I'm able to get an absolute amount. So I'm able to get about 262,500. So instead of recognizing the whole 350, I'll only recognize the 262. And remember, for depreciation, we debit depreciation account with that 262. And we shall credit accumulated depreciation so that is what you basically do have. Now, in this case, you've seen the examiner ask you something. They have asked you to draw up a non-current asset account, and I just want to demonstrate something here. One minute. Somebody asking a question, you can ask in case you're asking for the 1 minute from my side. So I'll have that. The examiner has also asked me to draw up an accumulated depreciation account. Just want to demonstrate for you for this specifically. Okay. He also asked us to draw a disposal account, but we shall not draw that for now. Just want to show you something here. What the examiner exactly wanted you to do. So they acquired 3 excavators at that value. You basically record this in your asset account. This asset was bought on 1st, 2019. This asset was bought by cash. The examiner has not talked about it, but it's either cash or bank unless they say it was acquired on credit, okay? And you can indicate these are excavators since this is a general account. So excavators were acquired, the total cost of that 1.4 million. So I'll say that I'll write this in thousands. So if I want to record my excavators here, I'll just say 1,400,000. Like that. So I've recorded this transaction within my asset, non-current asset account. Now, the examiner is also telling us that they also bought 2 compact machines on 30th June 2019. So it is still within the year, so I'll just record it even before I balance off. Remember, when you buy an asset, you debit the asset account. So say these were also bought by cash. They are compact machines. They are worthy 154 million. I'll just add 3 zeros on them. Okay. So let's see. Then they're telling us that they also bought a wheel loader. So they bought a wheel loader for 800 million on 1st October 2019. For 1st October 2019, there is a wheel loader. It was bought 800 million. So I'll say 800,000. Because I've put a degree of precision up there. Like that. So I've recorded this first transaction in my so-called what? In my so-called asset account. But remember, there are different periods, and the examiner has also gone ahead to say, prepare for the following years, a combined non-current asset, combined accumulated depreciation account. So for 2019 specifically, these were the purchases, and there's no sale that happened in 2019. It was just as is. So for 2019, after recording this, the only thing that is demanded of me is now to calculate the depreciation for 2019 for these assets before I close off my 2019. So as you have seen, when it comes to the excavators, we've gone on to calculate the depreciation respectively, and we have gotten the depreciation to be 262,500. So in my accumulated depreciation account, I'll come and say record on the credit side, 31st of December 2019. I'll say depreciation of excavators I'll come and pick the amount which I have, 262,500. But I'll just reduce the zero so that I can put a degree of precision here. UJX thousands. 1, 2, 3. So that is what I'll have. So I'll have to now depreciate all the others. So for example, these are compacts. I'll need to depreciate. But for their depreciation now, will not move from 1st April 2019 to move from when? It's going to move from 30th June. So it means that I'll still use the 25% that the examiner has given me for all the assets as my depreciation. So first calculate my annual depreciation for this, which would be the 25% which I have. This has to be multiplied by how much? By the cost, which is 1,540,000. Okay. Now, if it's 1,540,000, remember it has the 3 zeros, 1, 2, 3. So that means that $25% of this gives us 385 million. Okay. Remember, this depreciation is on reducing balance. But since in the first year, we don't have accumulated depreciation, because like this is the first time we are depreciating the assets, so we shall subject it to the cost. Okay, we don't have a value for accumulated depreciation for the previous period because it's a new asset. But the depreciation to be recognized for the period, which period is from the 30th June to 31st December, is actually 6 months. So I'm going to do 6 out of 12 times 385 that. So whatever this gives me is what I'll take, which is okay, I need to just confirm I wrote the right thing. It's 385 million. Wow. Okay. So it's 192, which is like a half. So this one, I'll come to and say 31st December 2019. Depreciation of what? Of compactor machine. I record how much? 192. I'll just record values and make 1, 2, 3. So I have about 192 there. Okay, that is what I do have. So I'm going to do the same thing for the wheel loader. Now my wheel loader, the value is how much? Is 800,000. So what I'm going to basically do is I'm going to get this 800,000 subject 25% onto it to get my annual depreciation. And what this will give me this gives me 200 million, because this one has 3 zeros. 200 million. So if I want the depreciation that relates to the period that I'm going to recognize, I'll count from 1st October 2019. So it's October, November, and December. Those are 3 months. I'm doing this because the examiner told us that depreciation is time apportioned. So I'll do 3 out of 12 times this value, which will give me 50 million. So it means that I'll record this here. Now you realize that I'm only recording this transaction here in my what? In my accumulated depreciation account. Why? Because the examiner didn't ask me for the depreciation account. So I don't want to waste a lot of my time doing the depreciation account. But all I know is that if at all the examiner had asked me to do a depreciation account, as I'm crediting these items here, I'll have to debit them in the depreciation account to complete the double entry. But for this case, the examiner was very clear on what he wants. The current account number, the current asset, non-current asset account, the actual depreciation account, and the disposal account. We don't have any disposals in 2019, so we don't have any assets to depreciate in that case. Okay, we don't have any of them. So we do have the so-called 2020. Now, before you move to another year, it's very important if you're doing questions like this to balance off your asset, to balance off your details. And we usually balance off at the end of the year. 2019, you'll have your balance brought down, which will be the total of this 3,340,000, 740,000. So you have this as your total. Then you have your so-called, sorry, this is balance carried down. Then you have your balance brought down of 370 right there. This is usually at the start of the new period. So you'll do the same thing as well for this. You basically have on 31st December 2019, you have a balance carried down of this total, which is 505,000. And you have this as the total here, and on 1st January 2020, you have a balance brought down of the same value, like that. So this account extends. So it means that if you balanced off and you're moving to the next period, great if they tell you that on 1st January 2020, PCL acquired a grader for 480 million. It means that you go and debit this in your non-current asset account. So you basically come here and you record that debt. So this is 480 million. I'll just record for 480,000 here. And I'll say, gosh, my grader, that. And they're telling us that this was bought when. The dates are very important here, friends. 1st January 2020. Okay. Now, that one I've recorded it. Remember, this transaction would also have gone through, let's say, the bank account in case they had asked us for information to do with the, maybe asked us to draw the respective accounts. Maybe it's a bank account. As you debit your non-current asset account, you'd expect it to credit your either bank account in case you bought it on through bank or cash, or if you had bought it as on credit, you definitely have to credit your accounts payables. So they're telling us item number 3 here, and I want you to be very observant here. They're telling us that one of the compactor machines that cost 800 million developed serious mechanical conditions and was disposed of at 305. This is within 2020. Now, and this is the only other transaction for 2020. Whenever you're disposing of assets, okay? Whenever you're disposing of assets, I want you to learn this, that for disposal of assets, our first step, whenever we are disposing of assets, we write them off from the asset account to the disposal account. To the disposal account. And we do this by debiting disposal account and crediting the asset account. So what that means is, in this case, remember they're telling us that this so-called machine that we bought, it got mechanic, so it was sold off. So in this year, we have to come here and credit it on the day it was sold. And they're telling us that they sold it when 1st July 2020. So if it's 1st July 2020, I'll come here 01 7 2020. I'll say disposal of how much? Of 800,000. You're basically removing it from your asset account. And you dispose it off here at cost. This should be at cost. When we are removing it from the asset account, we remove it at cost. We first ignore how much proceeds we actually got. We should first remove it at its cost from the asset account and take it to the disposal account. We take it to the disposal account. Now, the disposal account, as we sing here, this disposal account, as we credit here in the asset account, we should debit the disposal account. Just like what we've said here, we debit the disposal account and credit the asset account. So I'll come to the disposal account here, and I'll use the dates. So the date is 1st July 2020. The disposal account doesn't have any balance brought down. I'll just say, I'll call it, actually, you don't even have to call it disposal, you call it the wheel loader. Wheel loader is being disposed of and the amount is 800,000. I'll also put a degree of precision here. It's very important for the wheel loader. So what that means is that you have removed this asset from the asset account here, and you've brought it to the disposal account since it's being disposed of. Now, again, I want you to look here very attentively. As you realize, they're telling us that it was actually the compactor machine. Sorry, I think I don't know why I called it because I think it was resembling this. So just allow me just change something here and call this compactor machines. Compactor machine. It will not change anything else, just changing the name. Okay. Disposal compactor machines. Okay. So I wanted to say something that as you look at what we have here, if this asset was disposed of at 305 million, remember it was disposed of in the middle of the year. Being disposed of in the middle of the year means that this asset had actually depreciated for 6 months in 2020. Okay, so before even we dispose of, we have to calculate its depreciation up to this date, up to that date. So what I'm going to basically do is I'm going to calculate the depreciation for 2020. Okay. What I can do is let me depreciate all the assets. Okay. Let me depreciate all the assets at a go. So I can start with my excavators. Even if we are not disposing them, we'll need also to calculate the depreciation for them. Now, the excavators, I want you to observe very importantly. The excavators are still in our business. Remember, we bought them 1,400,000. Okay, 1,400 million. So their depreciation for the period 2020, in this case, in this year, they have been around. They have basically been around for the whole year, not like for 2019 where we had just bought them. So in this case, their depreciation shall be 25% times the net book value. Remember, the policy is reducing balance. So it will be 1,400 million. Let me just leave it at that first. Okay, let me add the 6 millions. 1, 2, 3, 4, 5, 6. Minus the depreciation for the first year to give us the net book value. The depreciation for the first year is 2625. 2625. 2625. How many zeros? These are 5 zeros. 1, 2, 3, 4, 5. This is in the bracket because the subjects that 25% on all this. So this gives me 284,375 as my depreciation for the period. So not forget, I'll come here and I'll say 31st December 2020 depreciation for excavator. Sorry. Depreciation for excavator is 284. Since I have a degree of precision, I'll remove the 3 zeros, is that value. I'll go to the second, which are my compactor machines. Here I'm limiting on my calculations, but you should be able to be elaborative in case you're responding to the answer. So for compactor machines, remember these compactor machines were of how much value? 1,540. Now for compactor machines, since we are selling off one compactor machine of valued at how much? One compactor machine is valued at 800,000. And the total value of these compactor machines, yes, right, was this much. So it means that being disposed of is 800 million. So we have to, this is what is remaining. So when we are calculating depreciation, we cannot just calculate and say 25% of this because not all these machines are around for the year. So I'm going to calculate depreciation for the two independently. for the one of the 800 that we're disposing of, and for say the 700 that we are that is remaining. So for the depreciation for the one that is being disposed of, depreciation shall be 25% times
Excuse me?
Yes, please.
That disposed of value you've used, isn't it actually for the wheelbarrow?
You can mute. Okay. I want you to observe something here. The wheel loader was bought for 800 million. But for compactor machines, they were bought at 1,540. But in 2020, we are disposing of a compactor machine that cost 800 million. So our mind is on the compactor machines because they're telling us they bought two of them at 1,540. So if here they're telling us that one of them cost 800 million, although it has a similar cost like the one of wheel loader, but what we are looking at specifically right now is on the compactor machine. That is why we have this 800. Okay, so that is very important to note. Now, I want you to look at here, very important. The depreciation, we are saying it's going to be, remember, it is 25% times the net book value. It's 25% times the net book value. But I just want you to be very attentive here as I am able to help you determine the net book value. Now, when we're depreciating this asset at the start, we depreciated them as a whole. So we depreciated the 1,540 as a whole. But when we are trying to dispose of, we want to separate them. So we want to get the depreciation for this period, but in getting the depreciation for this period, we also need the net book value for the previous period that related to the 800 million. So what I'm going to basically do is my depreciation will be 25% times the cost, which is the 800 the 800 million. Okay, which I bought the asset, but I have to remove the depreciation for the first year for this asset that I'm disposing of. Now, remember, for first year, we got the depreciation by getting 25% times 1,540. Then we got 385, which we subjected by 6 out of 12. So I'm going to do as if I only had the one of, I'm going to distribute the depreciation for 800,000 in the first year was, it is the 6 out of 12, which we multiplied, times the 25% times 800,000 or 800 million. Are we together? This that I'm highlighting here is my depreciation for the first year that could relate to this asset. The 6 out of 12 is just taking into consideration how long this asset had been for the first year. The 25% is the reducing balance method. Well, the 800,000 was like the net book value in year one. So this would be my so-called depreciation for the first year. Why I need it here is because I depreciate this asset on reducing balance. So I need to get the depreciation for the first year for this specific asset. Okay? Is this clear? Can somebody confirm that they understand this?
Yes.
Okay, fine, thanks. So if that is the case, I can be able to, sorry. So if that is the case, I can be able to find now my depreciation. Okay, so I'm saying this is 25%. I can just repeat it. Times 800 million. Minus 6 divided by 12 times 25% times 800 million. So this is what I'm able to get. I'm able to get 175 million as my depreciation for the second year for this asset. This is the depreciation for this. Let me see for the remaining one. So for the remaining one, it will still be 25% of the net book value. So what this means is it's going to be 25% times bracket 740,000 or million minus the depreciation for the first year, which is 6 out of 12 times 25%. I'm just combining the whole formula times 740 million. Which gets me to this value. Okay? Which gets me to this value. Now, this is annual depreciation. Okay? This is annual depreciation. Before even we think about one of them being going to be disposed of, this is annual depreciation that we are going to recognize. Now, because the one that is going to be disposed of was disposed of in the middle of the year. Remember, they're telling us it was disposed of on 1st July 2020. It means if we are looking at the depreciation to be recognized for the year, recognized for 2020. For this, we shall recognize the whole amount as it is. But for this, we shall again do 6 out of 12 times this to only know that we are recognizing only for the period when it existed, which is six months. That's why I'm doing 6 out of 12. So if I'm recording this in my account here, accumulated depreciation, what I'm going to do is I'll come here and say 31st December 2020. Depreciation, compactor machine. I have the one that is remaining is this value. I will actually I'll add them together. So that I just record a single figure, 249,375. 249,375. 249,375. That is what I'm going to have. I remove the 3 zeros since we have a degree of precision here. So that's what I'm going to recognize for this. Let me just do for the wheel loader, and then I do the aspect of disposal. So for the wheel loader, I want you again to see my annual depreciation for the wheel loader will be 25%, since it's the same percentage times the net book value. Now for the wheel loader, 25% times this wheel loader was bought at 800,000. So 800 million, sorry. So 800 million. I even put in brackets because I want to remove the previous depreciation. The previous depreciation was 50 million minus 50 million. That is what I'm able to get. So if I'm to get the answer for this is 1875. So I'll just come here.
Excuse me, sir.
Please.
You were talking about dividing the 6 months with the value of the remaining value of the compactor, which is 161. We divide 6 by 12 with that figure, as if you were talking about it, but I don't know where you ended.
Okay, the 6 out of 12 for 2020, we only apply it on the one that's going to be disposed because it was disposed in the middle of the year. That's where we subject the 6 out of 12. So I got this 175 million and subjected it 6 out of 12 times this 175 million to get the 87,500. But for the compactor that is remaining within our premises, we basically take the full amount. We don't subject it out of 6 divide by 12. I only did that when I was trying to compute the annual depreciation and taking into consideration as well as the depreciation for the first year. Is that okay?
Yeah, it's okay now.
Okay, fine, thanks. So for the wheel loader, this is clear. We get 187 500. So when you come to your to this 31st, where's my, okay, my depreciation. So depreciation for the wheel loader is actually this. It's actually 187 500. That is what we have. So once I'm done with that, I just want to dispose of this asset so that you can see exactly, because I just wanted to find out what I had. Now, in your steps for disposal, the second step you should do is write off. Okay? Write off. the accumulated depreciation that relates to that asset. So the asset that you're selling, you should try to ask yourself, for how much has this asset depreciated for the time it has been in our premises? So we understand that this asset, okay, this asset depreciated first year and then depreciated the second year. The second year, it depreciated 87,500, okay? For first year depreciation, remember we calculated the first year depreciation as together, these two machines as together. But in case you only want to get the depreciation for the 800,000, we've also just used it in this formula here, where we are saying that the first year depreciation is actually given by 6 out of 12. 6 out of 12, let me just first show you. 6 out of 12 of when the asset had been in the first year within the organization towards the year end times 25% times the 800 million. So this value gives us 100 million. So first year depreciation is actually 100 million. Well, the second year depreciation, we just calculated it to be 87,500. So this asset within our premises depreciated for a total of how much? A total of 1,875,500. So when you're disposing of an asset, you're supposed to go and write off its accumulated depreciation because it no longer exists into our premises. So we should also write off its accumulated depreciation. So I'll come on the day we are selling off, 1st July 2020. In the accumulated depreciation account and say disposal of my machine. I'm disposing of my machine, and this is compactor. I'm disposing of it has depreciated 187,500 for the time it has been in the premises. Don't confuse it with the wheel loader. We are speaking about the compactor, which we have calculated this value to be at this 187,500. So that is what we do. You should write off that value as that as our second step, okay? And here you debit your accumulated depreciation and you credit disposal account. That is what we've just done. That is what we've just done. So the next thing you should do is recognize. So this is the only stage now where we recognize how much we have received. Recognize the proceeds from the disposal. Which is debits now. Usually when you selling off an asset, usually they'll pay you either by bank or through cash. So you'll debit your bank or cash and credit disposal account. So in this case, the examiner told us that the compactor was disposed of at 305 million. So it means that if you have recognized that we don't have a cash bank account has not been asked for, but we have a disposal account, it means that we should come here and recognize on 1st July 2020, we have bank of 350,000. I wanted to, I'd forgotten to put this here. This is also in July. Even before I recognize this is July as well. I put it here. I need to recognize this accumulated depreciation. Like I said, as you debit it the other side, you should come and credit it here. And we had said it is 187,500. Okay, so that is what we have. Now in this account, as you can see here, this is our disposal account is looking like. Like you've seen, this came from the asset account. This came from the accumulated depreciation account. Well, these are the proceeds. Okay, so you should balance off your disposal account to determine a profit or loss on disposal. A profit or loss on disposal. Just look at this. If your asset was at 800 million and you it had depreciated by 187,500, which means that ideally your asset is 800 minus 187 in terms of value. Your asset is at 612 million, but somebody pays you 350 million. Ideally, you should be able to know that this is a loss on disposal. So your loss on disposal on that same day when you're selling off that asset, which is the day we use, you have a loss on disposal of how much of this value? Of basically the difference between this side and this side, okay? You can see that this side is 800 and this side is lower. This side is 5 this. So you're going to have this minus summation the summation of what we basically have this other side, which gives us 262,500. That is what you have. So this is the loss on disposal. In case this side was higher, then we should have had a profit on disposal. Okay, would have had it. And even this is what I'm trying to calculate in case you were trying to get this 6 minus what you got, you still get the same amount, 2,625. So this is what you basically get as your loss on disposal. This will be under your operating expenses. If it was a profit on disposal, it will be under our other.
Then you repeat on that figure you put under
Incomes. Which figure exactly?
that one of other loss on disposal. Because when you add, are you adding back the figure? Because when you add the 800 plus the 262, you don't get 800. So maybe explain more about that.
Oh, okay. Sorry. Sorry about that. I think I'd balanced off this. This is actually a balancing figure, this other side. Because we're just trying to balance off this account, okay? So this is 800, which is the highest, and then this is This one had 537. So to balance off, we had to bring in here the value to 500 to give us the 800,000 and 800,000. Is that okay now?
Yes, it makes sense now.
Okay, fine. Thanks very much for that. I'd missed it. So this is how you determine. So whenever you input these details, I think we saw that we had this detail in, and then we had these details. Your disposal account, you just now compare this side and this side. Then the balancing figure you have, wherever the balancing figure is, that would give you either profit or loss on disposal. As you can see, our loss on disposal is on the credit side here. So it means that the profit on disposal will be on the debit side, just in case it was that was the scenario. But in this scenario, we had the loss on disposal. Okay. Yeah, so that is what you needed to do here. So that is what examiner expected you, especially for this case. Now, I just want to comment about this and we end this class. They're telling us that on 31st September 2021, the grader was exchanged for a new one. The grader, I think we have a grader that was bought in 2020. It was exchanged for an old, it was exchanged for a new one. The old grader was valued at 380 million and management topped up 250 million to acquire the new grader. Now, for these transactions here, you have to first come and balance off your account for 2020. So it means that you add, for example, here, when you add this, I think this gives you about, okay, gives you this value. This one also gives you this value. You have a balance. Before you look at the next period, you need to first balance off, and this is at 31st December 2020. So you have your balance to be this minus this, I think. So when you add them, it should come to this, and this also balances. And then you have the balance brought down of the same value before you start on the next period. Okay. So you do that as well for the asset account as well. Just try to increase some space here. Okay. You do that for the asset account as well. So you can see that you need to make sure that you leave enough space between the two accounts since they work hand in hand. Just want to show you how to effect this. So the first thing I say that you have to write off the asset. This is another form of disposal. Although here we got proceeds, this is also another form of disposal where we're getting an exchange. So you should go to the asset account and write off this asset. And write off this asset at the original cost of how much? Of 480. So you go and credit your asset account with 480 million. As you credit this value in the asset account, you go and debit it in the disposal account with 480 million. That is the first step. Just like the one we did for the compactor machine. The second step will be for you to first depreciate this asset for 2021 in order for you to determine its accumulated depreciation from the time it was acquired. Remember, it was acquired in 2020. So there's a depreciation for 2020 and there's a depreciation for 2021 up to 30th September 2021. Once you get that accumulated depreciation, of course, even before you get, you now look at the accumulated depreciation. Update your accumulated depreciation account. Recognize the depreciation for each of these respective assets up to this one, the grader. So after you have done that, you get accumulated depreciation for the grader from the time it was bought up the time of sale. And this grader is being sold on 30th September 2021. So these are 9 months in the year 2021. So you calculate its depreciation based on that. Take into consideration that you're using reducing balance, just like the one we have done for the excavator. I want you to try it out. After you have done that, and you have debited the accumulated depreciation account and credited your disposal with the accumulated depreciation that you would have gotten for the 2 years, you now come and recognize the amount at which the old grader was valued. Now, in this time, they're not giving us money, but they're giving us a new machine. So what we shall do is we shall debit the asset account, because we have a new, and we are being exchanged for a new value. So you will debit your asset account with 380 and credit your disposal account with 380 of what the old grader was valued at. So it's more of like money, but in this time, instead of debiting our bank or cash, we are debiting the asset account because we are getting a new asset. So you do that, and then you're able to balance off your disposal account to determine either profit or loss on disposal. And again, you now proceed to do for the 350. This 250, you just basically debit your asset account. At the end of the day, you know that your new grader will be 380 plus the 250 in terms of value. So you already took the 380 when you are doing the proposal steps. Now you should take the 250. So that in total, the new grader that you've bought at this level is worth 380 and 250 million. So that is all you needed to do. So I encourage you to try out this and try out the whole number if you can, and share your response on WhatsApp, and then maybe I can be able to look at and correct you, especially on how you'd have accounted for this last part of the new grader. I encourage you, especially if you're a CPA student, when you look, when you try out some of these questions, we have an opportunity that on this same website, we have solutions for each of those past paper questions. So you can even try out some questions other than these questions that we've tried out, and go and find a solution and compare your results to see that you're now catching up. These papers, you can see the next part had something to do with the trial balance, where you needed to update the trial balance and draw a statement of financial position. And then there was also a question on nanny for profit. So I'm going to share with you videos for most of these topics. Why? Because we have limited time. So I want you to go through all those videos that I'm going to share on the WhatsApp group, so that you know each of these topics, that we can be able to utilize these times we are meeting just for revision. Okay? Yeah. So unless there is any question, I'd like to end this lecture right now. Let's utilize the chat box to ask any questions in the WhatsApp. In case you're not part of our WhatsApp group, please reach out to me on that number that I'll leave in the description. I guess you're watching the recording, but I believe that most of these people that are attending the live session on the WhatsApp group. So thank you so much, and wish you all the best. Bye-bye.